Hi friends, welcome to Stocks Daily, the channel where we let the billionaires work for us. So the market right now is oversaturated and really overvalued, and I know we can all feel it. All of our favorite growth stocks are super overvalued with the Fed money printers going all out. There's going to be a lot of inflation ahead, so we need to look for some safe investments and maybe not keep too much cash. I thought in this episode I'll cover something different from my usual growth-oriented tech stocks, and I'll take a look at Realty Income, ticker symbol O, also known as the monthly dividend company. Realty Income is a company with a strong cash flow, a great property portfolio, and a consistent dividend that is considered an elite dividend aristocrat, and even cited on Forbes.com as one of America's top 100 most trustworthy companies. Realty Income is a REIT, a real estate investment trust, a type of company that invests in real estate and pays the shareholders a dividend from their rental earnings or their general earnings. Personally, I'm investing a small percentage of my portfolio into REITs because I'm planning to reinvest the dividends back into the company in a long-term snowball effect. I understand the snowball growth effect is not substantial in short term, but with the market so overvalued, I see this type of investment as a sort of long-term hedge in case the Nasdaq has a major sell-off or falls into a bear market, because these type of companies tend to grow in relation to the property market. So I also see it as an indirect way to invest in property. Realty Income is a sound company, but it's not glamorous. If the goal is to make long-term money, then reinvesting the dividends to create a snowball effect will do that for you, but only if your time frame can be measured in decades. I'm a long-term investor, and I think that's the only proper type of investor, and I plan to hold the company for 10 or 20 years at least. So the gains in that time frame should be substantial. Realty Income is a particularly good REIT because they've had a fantastic dividend history and they've always raised their dividend payouts consistently, even during the roni. Right now, the dividend yield is just shy of 5%, around 4.7%, which is on the higher end of the dividend paying spectrum. So as we can see from the graph, the stock hasn't fully recovered from the roni lows in March. It's currently around $58, down from the $80 peaks that it was at in February. It's still down about 25% from its pre-roni peaks, so the stock is still at a discount and potentially an undervalued buy right now, but we'll investigate that further in the video. Historically, the company has seen relatively stable growth in the past 20 years, with the stock performing well in addition to the dividend payouts. In fact, from 1994, the stock was up 800% pre-roni, and the S&P 500 was up 600% in the same time frame. And this is what the graph would look like if you'd reinvested the dividends back into the company in addition to the growth of the stock. With a Class A dividend safety rating, it's as safe as a dividend-paying REIT gets, with no sign of slowing down after 23 years straight of boosting dividends, and I'll explain why in a minute. There's also no risk of the dividend being cut unless there's a large portion of its tenants that can't pay their rent, but according to their Q3 statement, they received almost 94% of their rent due in December, even with the shutdowns. So let's take a look at how this company grows their earnings. Their main strategy is increasing the size of their real estate portfolio and regularly increasing rent on existing leases as the property prices go up. They're constantly using their cash flow to buy more properties, which in turn increases the cash flow, which allows them to buy even more property. A constant cycle of growth. Coupled with the various rent increase methods, this results in increased revenue for the company, which basically results in increased dividend payouts for the investors. Here we can see the company's portfolio diversification according to property type. Heavily retail based, but about 12% industrial and agricultural properties with 3.3% offices. I'm not a huge fan of the office space, as I think after everyone's got a taste from the work at home, and companies are realizing that they might not need so much office space, but most retail will always be good. Most, but not all retail because of the e-commerce threat, obviously. However, most of the type of stores that they own will be great long-term, like the quick service restaurants, drugstores, dollar stores, convenience stores, as these type of stores, in my opinion, will be immune from e-commerce because they're essential and the items they sell are low cost. Also, in addition to the property type diversification, The location of the properties are well spread out, with the properties in 49 different US states, plus Puerto Rico and the United Kingdom. And I could testify to the insane rise of the property value in the UK, which I'm sure is similar to the rising property prices in the US, which means long-term growth and more rental income. The company's tenants are also well diversified, and some of them are investment grade. Tenants like Walgreens and CVS Pharmacy are essential, so obviously they're not going to go anywhere, and I foresee good growth for them moving forward. Also, Home Depot, Walmart, Sainsbury's, they all grew in 2020. However, the fitness tenants and the theatres are probably going to be under a lot of strain, but because the company is so diversified, they only account for a few percent of the total revenue. I am somewhat worried about the theatres and health and fitness properties because of the whole roni and all the shutdowns, but I think the theatres were dead anyway. They were dying because of Netflix and streaming, but the roni really put a nail in the coffin and finished them off completely. Health and fitness, however, I don't see it going away post-pandemic because not everyone has space in their homes for gym equipment, and not everyone wants to do yoga online. But the theatres not paying rent was a large part of the news that led to the stock price dropping, but I really think the market overreacted, and this is a short-term setback because the rents collected in December was 93%, which is fine, especially during the shutdown situation that we're in. And this is what Sumit Roy, the CEO of the company, had to say about the whole roni situation and the affected businesses.
So to understand the impact to our company, I'll briefly provide a bit of context. While we are one of 5 REITs in the S&P 500 that primarily owns retail properties, I want to draw a distinction on the type of retail properties we own, which are single-tenant net lease properties, which means our gross margins are almost 100%. More importantly, the vast majority of our tenant registry consists of essential retailers, just like you mentioned, that operates in industries with non-discretionary or low price point component to their business. Our top retail tenants are names like Walgreens, 7-Eleven, Dollar General, and Walmart. These are tenants that are holding up well, or in some cases experiencing tailwinds during this pandemic. I would suggest that our portfolio has performed well given the circumstances, and for the month of August, we collected around 94% of the contractual rent due to us.
Wow.
The one industry in our portfolio that has been disproportionately impacted is the theater industry, which represents less than 6% of our revenue and where our exposure is almost entirely with AMC and Regal Cinemas.
As Sumit Roy said, the majority of the tenants are essential retailers which are holding up well, and they're even getting tailwinds. So I don't see any of this short-term risk affecting the business too much in the long run. All in all, the roni impact on their properties seems to be small overall, with less than 7% of the rent collected from the total portfolio affected in October, November, and December. And the main areas affected are obviously the theatres and the health and fitness. According to the company, their business model is fundamentally different to other types of REITs who focus on shopping centres and malls. The company is focused on net leases and freestanding commercial properties, which drastically lowers cash flow volatility, especially when compared to shopping mall REITs. The average length of lease and the remaining average term is much higher than the average among other REITs, and the responsibility for property expenses are on the tenant rather than the landlord. And this all translates to gross margins, which are far better, with 98% gross margins compared to the 75% from shopping centre REITs. The volatility of rental revenue and maintenance is low, and there is no reliance on anchor tenants, which are basically larger tenants, often department stores and retail chains, whereas that's the main aspect of the shopping centre REIT, and that's due to the average retail property size. All of these characteristics add up to lower cash flow volatility, and that makes the earnings more reliable and the dividend yield more secure. One of the things I always look at before I invest in a company is the leadership. The company is obviously well run, as we can see from their 23-year track record, and there are decades of real estate experience on the board of directors. The chairman, Michael Mickey, has over 30 years experience in the real estate investment space with companies like HCP, the Irvine Company, and he was a partner in a law firm, Latham & Watkins. Sumit Roy, the current CEO, was a director of UBS Investment Bank prior to joining Realty Income as the chief investment officer. So the management team is obviously very well experienced, and personally, I trust them to run the real estate assets very, very well. Another thing that we should talk about is the company's debt. The debt has been growing steadily, which at first can look alarming, But when considering the debt to equity ratio, the debt levels are not too bad and have grown in proportion. And of course, real estate is usually backed by mortgages. And as long as these debts are leveraged to buy more real estate, for me, it's not a bad thing in the long term, as long as they don't use too much leverage, as that will make the cash flow volatile. But I have faith that the leadership are experienced and they know what they're doing. And if you take into account the rises in property value, then the debt to property value ratio is acceptable and on the safe side. So let's look at the company valuation to see if this company has a fair price at the moment. And a good way to value a REIT is to look at the net asset values, which is basically the value of the real estate owned by the company minus the liabilities. But unfortunately, I wasn't able to find up-to-date information regarding the current valuations of the properties held. So we have to value the company using the price to funds from operations ratio, or price to FFO ratio. Over the past few years, the average price to FFO for the company has been around 21x, and the price to FFO currently is at around 19x, so this would suggest that the company right now is undervalued compared to its historic price, and therefore it has some upside. The share price recently dropped from around 62 to 58 bucks on the stock offering news, and of course the share price dropped on the share dilution news. But for me, that's a good opportunity to enter the trade or to pick up some more shares and dollar cost average. I'm very bullish on this news, as the company stated that they intend to use the net proceeds from the offering to fund property acquisitions and bolster their portfolio, which in turn will mean more revenue and higher dividend payouts in the future. And also, I really like the fact that they're buying more properties, and obviously the management team are well aware of this whole roni situation. That means the property that they will buy will counter the negative effects of the roni. So to sum up, the company has a strong property portfolio, has well-diversified tenants, and a strong leadership team that has a clear plan. And it's got a fantastic track record. The stock price seems currently undervalued right now, so it's a great time to buy in, but only for an investor who wants to hold the stock for years to come to take advantage of the compounding effects of the monthly dividends. I mean, the whole point of a monthly dividend is because months come faster than quarters, obviously. So you can reinvest the dividends faster and faster and receive a bigger share every other month. Also, I know the management team is well aware of the roni effects, and the money they recently raised will help fund more properties that will perform well post-roni. But short term, all the ongoing shutdowns will likely put a lot of selling pressure on the stock, but long term, I think they'll be fine. My only concern is that retail spaces in the future will be in less demand, but society will always need essential shops. I really hope that the company invests more into industrial properties, but that being said, I have faith that the team will execute as they've done for the past 23 years and they'll innovate. This stock, albeit not glamorous, will certainly be a safe bet in the long run. So let me know in the comments below if you're invested in the company or if you're thinking about investing in the company. And as always, thanks for watching, smash the like button and subscribe if you like the content. Thanks for watching.